Hi there. So let's continue with our discussion on the overview of financial management. And in the previous video, we saw financing decision, and I made mention of the fact that when it comes to the financing decision, what are we doing? We are considering the issue about where we get the money from, sources of finance, and also what is the cost of capital, or what is the cost of that finance, which is the cost of capital. Then I made mention of the fact that there are short-term sources of finance and there are long-term sources of finance, and then I mentioned about the long-term source of finance that we can go for loan, and then also we can go to the equity shareholders. Now when it comes to the short-term sources of finance that are available to a company, we can talk about short-term bank loan, we can talk about bank overdraft, we can talk about trade credit, and also we can talk about various other forms of short-term finance arrangement that a company can have. Usually when it comes to the sources, the short-term finance, we will consider the cost in a bit slight way, because if we are finding out about the fact that trade creditors, okay, it's a short-term source of finance. For instance, if I buy from you and I owe you, and I'm supposed to pay you but I'm not paid you yet, meaning I can use your money to do something else in my business. What does that mean? That simply means that that money becomes what? A source of revenue to me. However, if I take long time to pay you how much money that I owe you, I'm going to lose my goodwill with you, because you would also need the money to be able to run your business. And that is what actually leads us to another topic in financial management that is referred to as working capital management. Okay, so about how much capital that we invest into the business. So that is actually closely related to investment appraisal and investment decisions and also financing decision. So working capital management is a topic that we'll be touching on, and that is where we will talk about issues about inventory, issues about cash, issues about trade credits, and issues in relation to debtors, right? So these are the four things we're going to be talking about, because the net of this gives us the net working capital. So how a company can effectively manage its working capital so that much money is not locked or invested in working capital. It's what we're going to be discussing under working capital management. So that is also another topic that is related to both the investment decision and financing decision, because when we find out how much money we have to put into the working capital of the business, how much inventory we can keep, how much we can allow as debtors, all of these has to be investment decisions. However, we need to find out where do we get the money from in order to finance that. So you realize that when it comes to working capital management, we are considering the issue about both investment decision and then financing decision. Now, I mentioned in the previous video also that the investment decisions are closely related to dividend decisions. Okay, dividend decisions. So when it comes to dividend decisions, what are we talking about here? We are simply talking about dividend, as you know, because shareholders invest in a company. So when the shareholders invest in a company, they expect returns. And as I mentioned earlier, how much money you pay out as dividend will affect how much money you are able to retain as a company. So if you pay dividend every year, or you pay a greater percentage of your profit out as dividend, meaning that you will be having less retained earnings, so that if there is any positive NPV project or there is any advantage in the market that you can take in order to gain competitive advantage, you cannot take, because you may not be having much money and you may have to go and borrow, and possibly you may not have the capacity to also borrow. So what a lot of businesses do is that they don't pay dividend, because you see, but then the policy of the company, we take into consideration various factors. So some companies don't pay dividend because the money is reinvested, and when the money is reinvested, the share value increases. So if, for instance, today the share price of the company is $2.5 per share, and we make profit and we are supposed to pay dividend, but we don't pay dividend, but we use that whole money to reinvest in the company, what is going to happen is that the value of the shares of the company are likely, all other things being equal, if it is a positive NPV project, it's likely to increase from $2.5 million to $2.5 to, let's say, $5. Meaning, After that period, when you sell off your shares, you are going to be making a profit of what? $2.5 per share. So the idea about dividend decision is going to be based on a lot of factors, and this is going to be a theory area that we'll be discussing, because the examiner may ask a question on that in level 2. Not all the time he likes asking question on dividend policy or dividend decisions, but in level 3 it's going to be very fundamental, because one of the key decisions that every business makes in many multinational companies, and especially the companies that are listed on the stock exchange, make is about dividend decisions. Because if we are paying dividend, then we are not going to be retaining more capital. If we are not retaining more capital, meaning that if there is anything that we need to undertake as a company, it will be difficult for us to undertake, quote unquote. A typical example of that is what we saw in the banking sector since last year, or since last 2 years, 2016, and then 2017, and then last year, 2018. We saw a recapitalization of firms from 120 million Ghana cedis to 400 million Ghana cedis. Many of the firms like EcoBank, UBA, and others had a lot of retained earnings, a lot of reserves. So all they did was to write to the Bank of Ghana. They did arrangements, and there was a transfer. And you know, we can do transfer from reserves, retained earnings, into stated capital. So meaning that they did not require much money or much capital from the shareholders, or to even go and borrow money in order to meet the minimum capital requirements. So it is some of these reasons why a company would have to pay less amount of dividend today, or maybe zero dividend, so that it will be able to reinvest the money and retain much of the money, so that if there is anything like this, the business or the company can handle it. Now there were other stories that some of the banks would have decided not to pay dividend, and the shareholders agreed not to receive any dividend for that period, and they used the whole money to just reinvest into the business so that they can meet the minimum capital requirements of the company. So that is why the dividend decision is closely related to the financing decision, because if we don't have money as a company to meet such a minimum requirement, then either we are going to merge, as we are seeing some of the banks merging, or our license will be degraded, as we see in GN Bank, its license being degraded, and or we deciding to liquidate as a company and fold up and just sell everything off and decide to go out of business. So that is what you have to understand when it comes to dividend decisions. A very key area of the syllabus. Theory more often, because we're going to just be doing a lot of readings, but in level 3 there are a couple of calculations that we're going to be doing when it comes to dividend decisions, because it depends on the structure, the profit that has been made over the year, so we can determine the dividend policy of 2 companies and decide which company is doing well and which company is not doing well. So that is what you must understand about dividend decision, how it is closely related to financing decision. Because let me say it again, if you pay out more dividend, it means that you are retaining less. When you are retaining less, when you require money, you may have to go and borrow, or go to the shareholders. What if the shareholders are not ready? And we saw one of a bank, I think Energy Bank, issuing shares, but the shares were undersubscribed, hence they couldn't meet the minimum requirements, and so they had to consider a merger deal with another financial institution. So these are the things that you need to understand when it comes to financing decision, and I'll see you in the next video as we talk about risk management decisions.